Welcome back from our offices in New York, where the remarkable news is that the S&P 500 has managed to make another all-time high in time for Christmas. That's remarkable because it's only 11 trading days since the last all-time high on December the 5th, but since then it dropped 5% over the great fears over Russia and oil, and since then, thanks largely to the Fed, it has managed to regain all of it. Meanwhile, the dollar is back at its own high for this year and indeed for the last 9 years, on a trade-weighted basis against its main trading partners. Quite remarkable. It all goes to show how difficult it is to forecast the returns of markets in the short term. In fact, there is a good argument that it is easier to forecast returns over the next 10 years than over the next one. And so I'd now like to talk to Tony Werley from JPMorgan Asset Management. They have a fascinating annual project in which they try to work out their long-term capital market return assumptions, what they're expecting for the next 10 years. And I have to warn you that they suggest we should be braced for a new normal when it comes to returns.
The sweet spot of emerging market growth is behind us. I think you could say that European growth is at or below where you might have expected it to be on a trendline basis. And if only the United States was the spoiler to that thought process. Our point of view is that a 2.5% growth rate over the next 10 years, which is anatomically very close to what we've seen over the last 15 years, would be the only exception to that lower global growth and lower global inflation.
So does that mean we should get used to lower yields across all other asset classes?
Without a doubt. Lower yields, lower inflation, driven not just by a lower growth in the global economy as well as global inflation, but also by the extracurricular demand, if you will, coming from pension immunization as well as the demographic immunization of older parts of the population globally trying to immunize their portfolios.
So that's what returns we can get from yield-producing equities. What about equities?
But over a 10-year time frame, we would expect that nominal returns in the United States for U.S. large cap would be more like 6.5% or below normal. And that would reflect the fact that earnings, particularly working through margins, really are quite elevated and have to come down. We would also expect that PEs would work themselves slightly lower and work off the excesses that we see now over a 10-year period of time. So you lose 1% plus through margins, you lose 1% plus of returns through PE contraction, and your earnings essentially grow with the nominal rate of GDP growth. Add some dividends in there and you get 6.5% nominal.
Okay, so that return is a bit below the historical average. Where can we actually invest to make the best returns over the next 10 years?
Our bet would be on emerging markets, and particularly Asian emerging markets. If you look at a building block approach for your return expectations between demographics, between the need to continue to build out economies, whether it's through capital expenditures or infrastructure, whether it's through potential margin expansion as they adopt the technologies and the techniques of developed economies, all of these play in favor of generating about a 10% total return compound for the emerging markets.
Okay, so emerging markets make sense, but do we really have the stomach to invest in them?
Well, I think you hit the nail on the head. A stomach lining of some thickness is really going to be called for here, because if you look for the volatility of emerging markets versus developed markets, there's a 50% or so additional premium or volatility associated with emerging market investing. On any given year or two, that long-term average might not look sane, quite frankly. But in the long run, where valuations and demographics in the longer-term trajectory of the economy eventually builds into stock returns, absolutely yes, that will be the best place to be.
All of that makes extreme sense to me. Be patient, take some antacids, and invest in emerging markets on a long-term view. Absolutely none of that says anything about what will happen next year, so you might not want to invest in them all at once. But it remains very true that it's probably easier to foresee the next 10 years' returns than to foresee what's going to happen next year.